Yesterday, I told you crude pushed back over $70 a barrel. That was wrong. And I want to fix it clearly today. I mixed up WTI. That's the main US oil price. I mixed it up with Brent, which is the global benchmark traded in Europe. I run a small shop and I read my notes wrong. And I appreciate your patience and actually some of you pointing that out. Well, I'm trying to correct the record here. So here's the simple picture. US oil prices are in the mid 60s. Global Brent is in the high 60s to low 70s. Natural gas just crashed from a weather spike, and now we're doing all this with fewer rigs and fewer workers too than we were a decade ago. I'm Mark Roach. I've been doing this supply and demand work since the early 90s, and my goal here today at FutureWise is to help you see how prices, policy, and geopolitics all fit together without the spin. Right now, as I'm recording or filming this in the US, here in Missouri actually today, the US and Iran are wrapping up indirect nuclear talks in Muscat, Oman. Iran's foreign minister has called it a good start and says that both sides are ready to keep talking, but there's no timeline yet for a follow-up round. The U.S. sent a mixed team of political and business envoys alongside Admiral Brad Cooper, who's the top U.S. naval commander to the region, while the USS Abraham Lincoln carrier group is sitting off Iran's coast. Well, that's a clear reminder of what's really at stake if diplomacy fails. The big sticking point is simple. Iran wants sanctions relief and insists on its right to enrich uranium, while the U.S. is pushing for a broader deal that also covers missiles, proxy militias, and human rights. Well, these positions are still far apart, and if talks break down, oil traders will quickly add a war premium back into the barrel. Over the last 10 trading days, WTI has traded roughly between $60 and $66 per barrel, with recent closes around $64. Brent has sat at a few dollars higher, mostly in the high 60s to low 70s, because it's the main global marker for seaborne crude. Prices spiked late January on war fears and then pulled back as these Oman talks were announced. I mean, that's the market removing some of the panic premium, and both benchmarks are on track for their first weekly decline in over a month. Natural gas at the Henry Hub, which is the main U.S. gas pricing point on the Gulf Coast, it spiked above $7 on average during the Arctic blast and then fell back toward $3.50 to $3.60 as the storm passed and futures contracts rolled to the next month. Think of it this way. Your winter panic price kind of went away and a more normal price has come back. And that's why your heating and power costs can swing so hard from one bill to the next. The government recorded a record storage draw of 360 billion cubic feet in a single week. That's the largest ever. Production has since recovered to about 106.6 billion cubic feet per day across the lower 48 states. On the drilling side, the U.S. is running about 546 rigs today, flat week over week, but down roughly 36 rigs from a year ago. Oil-focused rigs are down almost 69 year on year, while gas-focused rigs are actually up about 25. A quiet shift toward gas as companies chase export and power market demand. Direct U.S. oil and gas extraction jobs, well, that's the core upstream workforce, and it sits around 121,000 today. That's down 40% from 2014. In the shale boom peak, where it was at near 200,000 jobs. Yet U.S. crude production is still near record highs because better drilling, Technology, automation, and massive corporate consolidations have let companies do more with fewer rigs and fewer workers. If you include drilling and support companies, the broader upstream workforce is closer to 362,000. And that gap between huge production and lean headcounts is one reason oil towns feel more capital intensive and less people intensive than they did 30 years ago. Here's why policy and geopolitics matter so much. U.S. decisions on sanctions, export rules, and military posture often nudge oil and gas prices up or down, not just for American drivers, but for families in Europe, Asia, Africa, who never voted on those choices. So when Washington tightens the screws on a producer like Iran, Venezuela, or Russia, or working on China as well, it's pulling a lever on the risk premium baked into every barrel and every molecule of gas. For you, that shows up at the gas pump, on your electrical bill, and the jobs available in your region. A policy shift that trims a few rigs in the Permian or Haynesville might barely make a dent in national output, but it can change hiring plans for local contractors, restaurants, welders almost overnight. I will get things wrong sometimes, like yesterday's price comment, but I will keep always trying to show you the correct and get things on the record right. And keep showing you how prices, policy, technology, and power truly connect. So you can see past the headlines and understand the forces shaping your community and your cost of living. I'm Mark Roach, and this is FutureWise Energy.